Hey guys, what's up? So it's been a while since I made my last video, and I've gotten a lot of requests from people to start making videos again. So I'm trying to fit that into my schedule now. And given the impact of the coronavirus, I thought now would be a good time to talk about dividend investing since the market is has collapsed for lack of better words. So the stock that I want to talk about today is one that I've talked about before. Service Corporation International. It trades on the NYSE. Ticker symbol is SCI. So if you're not familiar with this company, basically they are a death care company. They operate funeral homes, cremation services, funeral services, that sort of a thing. Now, a lot of people have been asking me why the stock is down so much considering the business that they're in. So if you look at the year-to-date chart, it's down from the high 40s, low 50s to about $36 per share. One-year chart looks pretty similar to that. So right now it's trading about 18 times earnings, 6.6 billion market cap, and yields about 2.11%. So the reason why, at least in my opinion, why Service SCI's stock is down is a few reasons. First of all, they aren't operating their funeral homes anymore. In many states, they aren't a essential business, so they're being shut down. States like Washington State, you're not allowed to operate funeral homes at all. So that's put a very big impact on the business. And second, the thing you should know about the stock is they basically have two types of sales for the funeral homes, for any of their services really. So one is what they call at need, and that's when a family member passes away and you need to buy funeral services like a casket or a plot of land in the cemetery, and that happens around the time when the person passes away. And they also have something called pre-need, which is when they sell these services ahead of time, usually while the person is still alive. So they might be buying a casket or a tombstone or something like that 5, 10, 15, 20 years in advance. So basically, both of those services have essentially stopped. And given the economic impact of the coronavirus, a lot of people aren't working. They've gotten laid off from their jobs, working less hours. They may have been furloughed. So they're not exactly looking to spend, $10 or $20,000 for a funeral when they can barely pay their bills. So that's having a big impact on their services. And the second thing is, a lot of people are shifting because of the high cost of these funerals. They're switching towards more cremation services, which are a lot cheaper. You can do a cremation for less than $3,000 or $4,000 compared to 10 or 20,000 for a traditional funeral. But like I said before, funeral homes, cemeteries, they're not exactly operating right now, so the revenue is probably down 60, 70, maybe even 80%. So that's basically why the stock has gotten hit, even though most people that have written to me would think the stock would be up significantly. But I think it's still a great investment long term. The management team has been great for years. They've done a lot of good things in terms of capital allocation, and they've been growing the business at a very good rate for the last 10, 15 years. Now, there are a few things I want to talk about. So when you're investing in this type of environment where revenues from many businesses will be down up to 80, 90%, it's very important to look at the balance sheet and to assess the liquidity of the situation. And this is very true for dividend stocks where you're getting a dividend, and if the dividend gets cut, well, it's not good news for any of us. So I've pulled up the SCI 10K, and I just wanted to look at the financial statements. Now, I'm not going to spend too much time looking at the income statement. This is the 2019 financial results. So I'm not going to look too deeply onto the income statement because, of course, 2020 is going to be, for most companies, a write-off year. Revenues are going to be down significantly. So what I'm more interested in is the balance sheet. So this is the latest set of financials. They're expected to report Q1 results in about 3 or 4 days. So I'll probably make an update video once those results come out. But anyways, here is the balance sheet. So as of December, they have about 186 million of cash on hand, receivables about 81.7 million, and of course most of their assets are tied up in PP&E, specifically the cemetery properties. Now let's look at the liabilities. So they do have quite a bit of liabilities. They have the trade payables, and they also have the long-term debt. So they have about 3.5 billion of debt, which is pretty significant. So one thing you want to look for in these situations is when is the debt maturing? Because that could be, if it's maturing in the next year or so, it could potentially be a very big liquidity crisis, or they have to refinance potentially at unfavorable rates. So one thing I want to look at is the debt maturities. So most 10Ks, they'll have a section called off-balance sheet arrangements, contractual obligations, and commitments. So this is basically a table showing their commitments for their leases, for their debts, and other obligations that they'll have to pay out over the next 5 years or so. And this is a good idea to kind of ascertain what the cash flow requirements are going to be going out. So in 2020, they have 74 million of debt maturities. So that's principal repayments. They have about 170 million of interest on their long-term debt, which is pretty significant. And then smaller items like operating leases. So in total, that's $272 million going out the door in 2020. So that's pretty significant. Remember, I think they had less than 200 million of cash on hand. So they're probably going to have to draw down on some of the debt that they have on the revolving credit lines. So 272 million going out the door in 2020. In 2021 and 2022, in those 2 years, they have another 661.5 million going out the door. I'm going to guess it's pretty even between the two of them, so about a little more than 330 million per year. So for the next 3 years or so, they're going to have, between 270 to 330 million dollars going out the door to kind of fund the business in terms of the debt obligations. I assume they've already made some adjustments to their cost structure to keep the business alive. So this the contractual obligations payout schedule does worry me a little, just given the amount of cash they have on the balance sheet and the debt that they already have. So again, here's the balance sheet. So that's one thing that kind of worries me about the stock. I think they do have additional borrowing capability under their debt obligations with their banks. So that's good news. I'm not sure what the recovery schedule would look like for this business. I'm assuming it would be a longer term recovery because of the high cost of the services. Even though there is definitely a need for the service long term. Another thing you definitely want to consider is the buyback programs. So obviously they've stopped the buyback programs, but buybacks have been historically a great source of EPS growth for this business. They've reduced their share count by a lot over the last few years. So, from 2017, 2019, they've dropped about 5 million shares. So I'm guessing that goes away, and then they'll try to keep the dividend alive. They just increased the dividend to 18 cents a share in February, I believe. So it's yielding a little more than 2% right now, given the share price. But overall, I think the dividend is safe for the next 6 to 9 months. But after that, who knows? Given the large amount of debt on the balance sheet. But overall, I still like Service Corporation International a lot. They have a business that will always be in demand. The management team is great, and they've historically been a good allocator of capital. So we'll see what happens here.